Hey guys, it's Mrs. Lamphere, and I'm putting together this short kind of instructional video in place of our Class Connect today because I have some meetings later on this morning. So we are looking at Section 2 of Unit 9, and this section deals with cash funds. And with cash funds, basically this has to do with our sales and cash sales in particular. So there are two types of sales that a business can have: cash sales and credit sales. At times when a cash sale is made, the customer may not have exact change and needs change returned to them. So this would require the cashier to maintain a cash fund with change in it. So your cash fund is basically the amount of money that you have in the cash register at the beginning of the day and throughout the day in order to make change for the sales that you have that day. So in this section, we're going to learn how a change fund is maintained and how change fund related transactions are recorded in the accounting books. So let's move on to page 4. Funds means cash. So keep that in mind. A change fund is the amount that the cashiers need to maintain to pay small value balances when customers pay with bills and subsequently need change. So again, the change fund is what we keep in our cash register so that if someone pays $10 for an item that costs $8.20, we can give them $1.80 in change. All right, but with this change fund, we need to kind of keep track of it and at the end of the day, kind of record where we're at with our change fund. So let's take a look at this page. Consider the following example. January 15th, the account at Olympic Sportswear wrote check number 112 for $200 to establish a change fund. So they took cash out of their cash and bank. They wrote themselves a check for $200 to take that cash out and put it into their cash register or their change fund. So this is what that transaction looks like. Our change fund is an asset account. Keep that in mind because it's still looking at our cash. So when we write a check to ourselves to establish this change fund, we're taking it out of our bank account and putting it into our cash register or our change fund account. So again, asset account increases on the debit side. We're taking that money out of cash and bank and putting it into our change fund. And this is what that journal entry would look like. Debiting change fund, crediting cash and bank, and recording our source document. So when we're using our change funds, at the beginning of the day, the sales clerk puts the change funds into the cash register drawer. So we take that $200, we put it in our cash register. When a cash sale occurs, the sales clerk inputs the cash on the cash register. The sale is automatically recorded on the cash register tape. So the tape kind of keeps track of all of our cash sales that day. At the end of the day, the clerk counts the cash in the cash register drawer. The cash in the drawer should equal the cash sales of the day plus what we originally had in the change fund. So we had that $200 in there to begin with. We should, at the end of the day, it should equal everything we had in cash sales plus that $200 still. The amount of cash in the change fund is set aside for use as change for the next day. So the sales clerk and the supervisor should check the amounts individually and sign a cash proof. So the sales clerk kind of, at the end of the day, checks their drawer, and then the supervisor verifies that they have the correct amount. The cash proof form is attached to the cash register tape and is used as the source document for recording the cash sales for the day. Okay, as humans, we all make errors, so sometimes there can be a cash mismatch. So at times while recording a change fund, a sales clerk may make an error and give the incorrect amount of change to a customer. We might have actually had that happen before. Giving less change to a customer is known as a cash over. Giving less change to a customer is known as a cash over. So that means we have more money in our register than we should because we did not give as much change as we should have. Fortunately, this is considered revenue for the business. If that person didn't come back and correct it, we keep that money and it's recorded as revenue. If a sales clerk gives more change than required, this is treated as a cash short or a cash shortage. Cash short is an expense to the business. So if we accidentally give out too much change and later on our drawers not adding up correctly, that leaves us short. That's recorded as a cash shortage, and that is an expense to the business. When neither of these things occur, the amount of cash in the cash register drawer less the beginning change will not tally with cash sales. So when either of these things occur, so whether we have a cash overage or a cash shortage, the amount of cash in the cash register drawer less the beginning change fund will not tally with cash sales. So that's just saying our numbers are going to be off. So we kind of have to account for that in our books. So the amount that is gained or lost because of errors in recording is recorded in the cash short and over account. So we have a special account set aside for such errors, which is kind of nice. This is a temporary account. So this is just kind of, it's not one of those permanent accounts where the balance is going to carry over. This is a temporary account that will close out eventually. All right, so let's look at this example. On January 16th, the cash register tape shows that cash sales is $1,040. Sales tax was $52 for a total sale of $1,092 for the day. The actual cash in the cash register after subtracting the amount of change fund is $1,090. So we're $2 short somewhere. So this is how that transaction would look. This is our cash and bank account. So we're going to take, this is the amount of money that we have for the day, and we are taking that to the bank. So we are debiting our cash and bank account. We're accounting for our cash short and over account. So if it's a cash short, you'll notice it's going to be debited. They don't necessarily have the plus and minus signs. They kind of call this a cash, this is the cash shortage, this is the cash overage side. So then we continue, we have our sales. We credited our sales for $1,040 because that's the amount of merchandise that we actually sold. We are crediting sales tax because that is the amount of sales tax payable we are adding to that account. So those two accounts are credited or increasing. And then we have to, another way to kind of, if you can't remember whether or not you should debit or credit this cash short and over account, you could fill out these three accounts first. So you know you're debiting, you have $1,090 that you're taking to the bank that day. You know you're increasing your sales account by $1,040. That's how much you did in sales. You're increasing your sales tax payable by $52. Our debits and credits need to equal. So right now we have $1,090 in debits and $1,092 in credits. So that kind of also helps you figure out, okay, this must be a debit then, because I need $2 more in my debits to equal my credits. Okay, and then this is what the journal entry would look like. We have our cash and bank being debited, our cash short and over account being debited, our sales revenue is being credited, and sales tax payable credited. Okay, so that brings us to the first part of your assignment here. So in this assignment, it's the same type of setup here. On May 16th, the cash register tape shows that cash sales are $2,080. Sales tax is $104 for a total sales of $2,184. The actual cash in the cash register drawer, after subtracting out the amount of change fund, is $2,180. So we are $4 short from what's in our register. So now we need to prepare the T accounts to record this transaction. So I'm trusting you guys to be able to do this on your own because it's exactly like this transaction. So this was a shortage that we accounted for, and same with this assignment. It's going to be it's a shortage. We don't have enough money to cover what we should be covering for sales that day. So record the correct amounts in these T accounts and then record the correct journal entry for that. Okay, the next part of this assignment talks about the petty cash fund. And a petty cash fund is something that a business kind of keeps on hand for smaller purchases. So businesses need to write checks for expenses of small amounts towards delivery fees, postage stamps, supplies. To make payments for such amounts, businesses create a small fund called a petty cash fund through which cash is dispersed. Using a petty cash fund saves time and is cost effective. So again, this is just like basically a fund that a business has in the office, kind of on the side for, again, these kind of smaller purchases that we need to track. So establishing and maintaining a petty cash fund based on its past business transactions, the business allocates a certain amount of money to the petty cash fund. So based on what they've spent in the past, maybe they kind of know, all right, come in May, we're going to need more pens and pencils and erasers, or in June, we're going to need more printer paper. So they still kind of look ahead and to get a certain amount of money in mind that they need to put in the petty cash fund. The concerned authority, the person in charge, estimates the amount needed for the fund and writes a check to the person in charge of the fund, who cashes the amount and keeps it in a petty cash box. Literally. So when I was working my marketing job, we had a petty cash box that our secretary kept locked in the file cabinet at her desk. And whenever we needed to go get some supplies, again, for small expenses, we would go to her and she would break out the petty cash box and we'd go get our supplies. For small expenses such as pens, pencils, stamps, the person in charge of the petty cash disperses the cash required. Petty cash fund is maintained for a specific period of time, usually a month. So the petty cash fund is created every month to suit the business's requirements. Petty cash fund is treated as an asset account. So again, money set aside for that month to be used for these small purchases. In order to maintain the petty cash fund, a petty cash box is kept in the office. A petty cashier manages the petty cash fund and disperses the cash for the petty expenses. At our office, it was our secretary. She was our petty cashier. Okay, recording an entry for establishing a petty cash fund. This is the same kind of look that we saw when we established our cash funds for our cash register. On February 1st, Olympic Sports wrote a check number 113 for $100 to establish a petty cash fund. So again, we're crediting our cash in bank. We took that money and we put it in our petty cash fund. Both are asset accounts. We're just moving that money over. This is what that journal recording would look like. Petty cash voucher. This is a proof of payment from the petty cash fund. It includes the date, whom it's paid, the purpose. So basically, if I were working in an office and I needed to run and grab some pens for my office, I would go up to the secretary and I would say, Liz, I need to take some money out of the petty cash account and go buy some supplies. So she would make a recording on this petty cash voucher, which is just a kind of a proof that money came out and went to me. So in this instance, it was $6.30 for printer paper. It's going to our supplies account. So this is really important. They're still tracking what account this affects, okay? But instead of recording this right away, we wait until the end of the month, and then we look at all of our petty cash vouchers and we make these recordings. Okay, let's skip over these little tests. Replenishing the petty cash fund. When the petty cash fund is depleted beyond a certain limit, so they set a limit, like maybe once it gets down to $50, they want to have it replenished. When it gets to that point, it needs to be replenished. To replenish a petty cash fund means to restore the fund to its original cash balance. Replenishing the petty cash fund affects the general ledger accounts that are affected by petty cash disbursement. So, replenishing the petty cash fund affects the general ledger accounts, so our supplies that we purchased, maybe we spent some on computer equipment and we have an account for that. So whatever accounts that were affected, whatever accounts show up on our petty cash vouchers that we use the money for, those are the accounts, the general ledger accounts it would affect. Stationary equipment, delivery expenses, those types of things. Replenishing the petty cash fund requires reconciling the cash balance and then preparing a petty cash requisition. Reconciling a petty cash balance. So, for instance, a petty cashier reconciles the petty cash fund to determine the balance. He or she adds all the petty cash vouchers and then subtracts the amount from the original amount. So we look at what we had in our petty cash box, what was paid out for supplies, other small expenses, and then we should have $9.50 in change. So if that's the correct amount, the petty cash fund is in balance. So that's pretty simple. We're just kind of making sure that, okay, we had $100, we spent $90.50, we should have $9.50 left in our petty cash box. We do. Everything is still in balance. Okay, then we put together a petty cash requisition form. After reconciling petty cash, the cashier prepares a petty cash requisition form, sorts out the petty cash vouchers by account, and totals the amount. So they lay out all their cash vouchers, they add up all the supplies, they add up all the delivery expenses, utilities expenses, advertising expenses, and they add them all together so that they'll each go to the correct account, and then total cash needed to replenish fund. So this is how much money was taken out for these different expenses. So this is how much we need to put back in there once in order to replenish our fund. Petty cash register. Oh, this just kind of explains some larger businesses might have like an entire register set aside for petty cash. Journalizing a check to replenish. Okay, here we go. So on February 28th, the accountant at Olympic Sportswear writes check number 234 to replenish the petty cash fund. Identify the accounts. All right. So again, we tracked all of our expenses on the vouchers, the petty cash vouchers. So at the end of the month, we see we spent $25.45 on supplies, $19.75 towards delivery expenses, $30 towards utility expenses, $15.30 towards advertising expenses. So we're going to record all of that money in the appropriate accounts and then write a check to replenish our petty cash fund. So we spent $90.50 dispersed through all these different accounts. So now we need to replenish petty cash by taking that out of our cash and bank. And here's what that journal entry looks like. Okay, so again, at the beginning of the month, we write ourselves a check for $100 and we put that aside in our petty cash box. Throughout the month, we take some money out for supplies, some money out for delivery expenses, utilities, advertising expenses. At the end of the month, we see we spent $90.50. So now we need to take that money out of the cash and out of our bank and put it back into our petty cash fund in order to get it replenished. But you'll notice we don't debit our petty cash fund again. We're debiting all these expense accounts because we are divvying them up to the correct accounts that need to be expensed. Okay, I think that's all I wanted to cover for the second part of this assignment. So in part 2, it's the same type of setup as that example we just looked at. February 22nd, American Sportswear writes check number 567 for $89 to replenish the petty cash fund. The following are the classified accounts total. So this one's really pretty easy. All you have to do is label out your T accounts with the separate account names, and then we are assigning all of these amounts as expenses to these accounts. And then we are writing a check for $89 to replenish the petty cash fund. So you know how much is being spent in total from that's going to be taken out of our cash and bank. These are the amounts going to the different accounts. So we need to line them up correctly, make the recording in the T accounts, and then pass the journal entry. Okay, so that's going to look a lot like this example that we looked at on page 20. So if you're confused, refer back to this page 20 to help you out with this assignment. And that is it for these assignments. Make sure you finish the rest of the reading in order to complete your study guide worksheet. And after that, you should be good. Oh, this looks like another example on page 23 of the same type of example here. Sportswear, total of the petty cash, the amount dispersed was as follows. Supplies, delivery, utilities, advertising. That even looks like the same amounts that we have here. Close. Okay, so you should be good to go on part 2. When you're done with that, submit it and let me know if you have any questions.